Today we are looking at 4 REITs that every investor must have in their portfolio. We're going to explain why that is the case. We're going to look at each company in detail, also looking at their dividend safety. We're going to run through some important financial metrics, in particular for real estate investment trusts. And as always, we are going to point out whether or not we believe them in this moment to be undervalued based on their intrinsic value, and we'll discuss our acceptable buy price factoring that investor margin of safety, and we'll also let you know what Wall Street are forecasting for the next 12 months. And if that is not enough, we are going to take a look at 2 ETFs. We're going to look at VNQ, so that is the Vanguard Real Estate ETF, for those that prefer not to pick any individual REIT. And we're also going to look, for those that are unable to hold VNQ, we're going to look at the equivalent or very similar, the iShares US property yield. Now this is for those who don't have access to VNQ, or essentially for those who are European investors who want to take a look at holding a REIT ETF. So let's jump straight into the first one, the very well-known monthly dividend payer. It is Realty Income Corporation, ticker symbol O. Now, it is down 11% over the last year, and we do want to point out, again, it is important to note that this is one of the few real estate investment trusts that do pay every single month. We can see currently they are in the midpoint of the 52-week range. They offer a yield which is paid 5.7%, and we can see the P to FFO at 12.81. Now, if you've been a holder for this over the last 10 years, you would be up around 37%. Bear in mind, this doesn't include dividends reinvested, and we can see just pre-pandemic, it did have its all-time highs at around $80, and it is one that we do believe will turn around when we do start to see those interest rate cuts coming towards the end of this year. Now, in terms of dividend safety, we have a safe score of 80, the market cap at $47 billion. It is a large cap company. Now, in terms of looking at recessionary metrics, last recession, 07-09, they did in fact increase the dividend. They had negative 0.8% recession sales. Bear in mind, this was above the average growth of the S&P, which sat at negative 12, but they did outperform the S&P, although marginally negative 43 versus the S&P's negative 55. Now, in terms of dividend growth, we can see over the last full year, they did increase by 3%. Over the last 5 years, again, the very same. Over the last 20 years at a 5% level. Now, on the channel, we do advocate to try and aim for an increase of at least 4%, whether it's your dividends, your other income-producing assets, or even your salary, due to the fact that the US inflation rate was 4% over the last 40 years. If you're getting less than that, you are in effect losing your purchasing power and taking a pay cut. Now, Realty Income are a dividend aristocrat. They have been increasing those dividends for 25 years or more consecutively, and we can see they have been paying a dividend for the last 55 years without a reduction. Now, in terms of dividend yield theory, for those that are new to the channel, it states the company is undervalued when the current yield sits above the 5-year average. So we have a sign both on the yield and the forward P to AFFO, so a double undervaluation signal. We do note, however, it isn't too far off the real estate sector P to AFFO of 13.9, and do keep into consideration that we're not looking at any of these models in isolation, and we will conclude towards the end of the episode. In terms of the payout ratios, if you are a frequent viewer, you know we prefer the free cash flow. However, for REITs, a lot more volatile. So we draw your attention to the adjusted FFO, which stands for funds from operations, as we can see here. We want to look for a blanket rule for REITs of below 90%. Nice to note, not only has Realty Income not gone above that, but we can see it has been decreasing the last 2 years at 76%. 2024 expected to go slightly lower to 74%, so there's a positive bonus, and it does give us that security that the dividend score of 80 does look to be correct. On top of that, the adjusted funds from operation per share has been continually increasing year on year, a lot of consistency. 2024 expected to be more of the same at $4.17. And for those that want to see that in a percentage format, we can see here looking around the mid-single digits across the board on average. Although 2023 was 2%, 2024 is expected to climb higher at 4%. And if you've seen our previous videos with the merger with Spirit Realty Corporation, we really do believe that that will have some strong synergies for O. On top of that, for top line, we want to see 5 to 10% growth, and we do see, in fact, a lot better than that nearly every single year. The last 3 years showing some real growth to their top line, and we can see, numerically speaking, it has more than 4 times from $930 million to $4.08 billion. As we go along these REITs, do take note, some will dilute your position at a much quicker rate, as we can see, very typical with REITs. Other companies, we do like to see share buybacks with the opposite direction, but REITs do need to issue equity, and the reason for this is due to the fact that they don't retain a lot of their internally generated cash flow and therefore need to issue equity to fund property acquisitions. In terms of ROIC, as always, 10% or more for REITs, 3 to 5%, and we see there or thereabouts over the last 10 years, 3% over the last 2 years at the lower end, so I would like to see this climb up slightly to 4 to 5%. Operating margin, whilst it has decreased over the long term, still healthy at 42% in 2023, but I would like to see this back up to the 50% levels that we saw not too long ago. In terms of the net debt to EBITDA, now this is important, especially for REITs. We don't want it to be higher than 5.5 as they do take on a lot of debt, as you would see in our deep dives when we look at real estate investment trusts. Essentially, these are the number of years it would take the company to pay off all of their debt. We can see over the more recent period, it is above 5.5. Nice to note, however, 2024 it is expected to come down, but the more recent year, it is fairly high at 6.05. Now, in terms of looking at the valuation, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically when we do deep dives, we do run through every single one of these models. Today's episode, Realty Income, let's get straight to the intrinsic value, which is the average of the three models you see on screen, coming to $65. Now, with a current price of $54, it has rebounded nicely from the lows where we saw in the mid-40s. Looking at a 10% margin of safety, we use that if it meets the three criteria: the wide moat, the strong financial metrics, and the good forward-looking data. And then we keep going till it's near the current trading price, and we can see it is pretty much around that 15% MOS level. As always, the margin of safety per investor will differ depending on their investment thesis and their risk to reward ratios and how they see this for each stock in their portfolio. So 15% MOS level, and we do have Wall Street targeting a $61 price target over the next 12 months. So they do see around 13% upside over this period. And as always, do let us know your thoughts in the comments, whether or not you are adding to any of these stocks or they are on the watch list waiting for a certain price target. Now, just to let you know as well, we have released our latest free weekly article. If you do want to gain access to this, as well as all the other articles, all completely free, you gain instant access. Just click on that pinned comment below and you can sign up. Now, the next REIT we are taking a look at is Vici Properties. Now, this is in the gaming and entertainment industry. We are taking a look at different REITs today, 4 of them in different industries within the real estate sector. As we can see, this is down around 6% over the last year. We can see currently trading in the mid to lower end of the 52-week range with a yield of 5.6% and a P to FFO of 11.5. Now, over the last 5 years, however, it is up around 37%, but we can see all-time highs sitting around a $35 mark summer 2022. So in terms of the dividend safety, 50 borderline safe. Again, we will take a look at the net debt to EBITDA to understand that. Market cap 31 billion, a large cap company. So last recession, well, in fact, they were only listed around 2017, so we don't have any of that data available to us. But we can see last growth 6.4%, very healthy, very nice, and above the inflation target of 4%. Last 5 years, double digits, lots to like about this company, and they have been increasing those dividends for the last 5 years. So let's take a look at dividend yield theory. So we can see that undervaluation signal again, both on the yield and on the forward P to AFFO. So in terms of the real estate, similar to Realty Income, it isn't too far off the real estate comparison. So looking at the adjusted funds from operation, now for hotel REITs, if we want to be more specific, 75%, that is pretty much in line as we can see over the last few years and expected in 2024. And in fact, this is one of their KPIs, their key performance indicators, at keeping their FFO payout around the 75% level. Now, in terms of the adjusted funds from operation, nice to note the consistent growth year on year across the board. 2024, again, expected to increase, so no worries with their performance based on their forward guidance as well. And we can see their adjusted funds from operation per share growth looking healthy. 11% in the last full year, expected to come down to 4% in 2024. And we can see numerically, they have gone well above the 5 to 10% over the last 4 years, looking very strong, and hence why their total sales numerically has gone from around 200 million in 2017 to 3.61 billion. Similar to Realty Income, they will dilute your position at a fairly quick rate, as we can see, increasing from 228 million to 1.02 billion in the latest period. ROIC, though, it is looking very healthy, above that 3 to 5%, 8% in the more recent year. And when we focus on the operating margin, looking very, very strong, in fact, in the 90s in 2023. Finally, the net debt to EBITDA, which does correlate to that dividend safety as well as balance sheet strength. We can see for hotel REITs below 3.5, whilst that is the target, 5.86, very high in 2023. Expected to be a little low in 2024, but I would personally, as an investor, like this to come down a little quicker. But we can understand why that dividend safety score does show borderline safe. In my own opinion, as an investor, based on the adjusted funds from payout ratio, it doesn't look like this dividend is in any real worry. And we can see they have continued to increase those dividends year on year over the last 5 years. And with their forward guidance, again, no red flag indicators. So personally, I'm happy with that. In terms of looking at their valuation, and don't forget you can grab a copy of this valuation model to get to both the intrinsic value as well as the acceptable buy price of companies in your own portfolio by clicking on that pinned comment below. So margin of safety at 10%, we see a buy up to $34, at 15% up to $32, at 20% around the current trading price, is not too far off. So for Vici Properties, we do believe it has a 20% MOS level based on our estimates and judgments. In terms of Wall Street, well, they believe 20% upside, price forecast target of $36, so they do believe Vici Properties, along with Realty Income that we just took a look at, as a very strong buy now, in addition to those in your REIT portfolio. The next must-own REIT in your portfolio is Prologis, ticker symbol PLD. Now, as we can see, they are up around 12% over the last year. Over the last 10 years, up a strong 217%. We do know all-time highs sit around the $170 mark around 2 years ago, and we do know that it is towards the upper end of the 52-week range, with a yield just below 3% and a forward P sitting around 23.66. Dividend safety score, well, 61 safe, market cap 120 billion. It is a mega cap company. Last recession, well, in fact, they did cut the dividend. They had below average growth, and we can see they took a bit of a hammering, down 84%, significantly lower than the S&P 500. But looking at dividend growth in the more recent period, double-digit increase just last month, double digits on average over the last 5 years. But given their dividend cut, we do know over the last 20 years, it is showing at 0%. And when we look at their dividend growth streak, they have been increasing those dividends for the last 10 years. Now, dividend yield theory, as we can see, it is showing an undervaluation signal on the yield. However, we do note the forward P to FFO does sit roughly in line with the 5-year average and significantly higher than real estate's 13.9. So let's take a look at the payout ratio. No real worries over the last 10 years. More recent year at 70%. Given this is an industrial, we do have that 75% maximum target. Although we do note it is expected to increase higher to 87 in 2024. Something just to keep an eye on moving forwards in terms of their guidance and their annual report. Adjusted funds from operation, whilst it has increased over the last 10 years, it isn't massively consistent, as we can see the drop from 22 to 23. And bear in mind, 2024, they are expecting a drop to their adjusted funds from operation. In terms of growth, well, again, very strong up to 2022. However, the last 2 years, or 2023 and expected 2024, is deemed to be negative. Sales growth, they do very well, 5 to 10% at a bare minimum. The last 2 years, strong double-digit growth to their top-line sales, and that can be seen by an increase of more than 4 times over the last 10 years. Again, very typical, as we mentioned, they have diluted your position over the longer term by doing a lot of share issuances. In terms of the ROIC, increasing over the longer term, which is a positive sign, and over the more recent years, 3 to 4% level is within our baseline. So looking at the operating margin, we have that operational efficiency sign increasing from 24% to 41% over the last 2 years. Finally, the net debt to EBITDA, very nice to note that it has been decreasing over the longer term. And whilst we look for below 5 for industrial REITs, it hasn't quite hit that in 2023, but 2024 they are expected to be below that. And it is positive just to note the trend, it is decreasing, and they have pretty much been on that path over the last 10 years. So in terms of the valuation of Prologis, ticker symbol PLD, we get to the essential intrinsic value, the average of these three, at $156. So taking a look at the margin of safety at 10%, a buy up to 140, at 15%, not too far off the current trading price, so we do believe that Prologis has a 15% MOS level. Incorporating Wall Street's forecast of $149, they see upside of 14%. So again, the third REIT that we have discussed today that does show undervaluation signals and a strong buy from Wall Street based on their forecast. As always, do drop your thoughts and comments below. We then move on to the next REIT, which is Digital Realty Trust, ticker symbol DLR. Been on fire over the last 12 months, up 58%. We can see over the last 10 years, however, up 170%. A little bit away from its all-time highs, as we can see, of $177 at the back end of 2021. And we do see it trading at the upper end of the 52-week range with a yield of 3.4% and a forward P to FFO of 21.63. The dividend safety is safe at 80. The market cap is 45 billion. It is a large cap company. Now, in terms of those recessionary metrics, we're actually fairly positive. They increased the dividend. They had plus 21% recession sales, and they outperformed the S&P with their negative 27% return. Dividend growth, well, they haven't increased it since 2022. However, over the last 5 years and the last 10 years, it does sit at that inflationary level of 4 to 5%. And we can see they have been paying a dividend for the last 19 years without a reduction. So looking at dividend yield theory, we have a sense here of reasonable valuation on the yield and not too far off reasonable / slight overvaluation based on the forward P to FFO. And again, similar to the other stocks or REITs that we have reviewed, a little bit higher than the REIT P to FFO of 13.9. Adjusted FFO, no real worries, below the 90% pretty much every single year. 2024 expected at 80%. It is a very healthy level for this REIT. In terms of the adjusted funds from operation, not as consistent growth as we would like to see with any of our investments, although it has increased over the longer term and is expected a strong increase into 2024. And when we take a look at that percentage-wise, it is expected 5%, although it is key to highlight over the last 10 years, 5 of those years have been negative. And we can see around that 5 to 10% level at a bare minimum year on year, with the last year at 16% looking very healthy. For those, again, who like numbers, it has increased by around 3 times over the last 10 years. And similar with all these REITs that we do review, they do dilute your position. However, there are some that we have reviewed over the last few months that don't really dilute your position as rapidly as others. Notably, from memory, we are talking about companies like Mid-America Apartments, Extra Space Storage as well. ROIC a little bit lacking at 2% over the last few years. Nonetheless, this is a very strong REIT, and we would like to see them back up to the highs of 5% we saw in 2014 and 2016. Operating margin, whilst it is still higher than the minimums of that 12%, it has been decreasing over the longer term. So even though their top line revenue is increasing, we would like to see their operating margin at a minimum increase to around the 18 to 20% level. Finally, the net debt to EBITDA. 5.87, it is above the 5.5, and it has pretty much straddled along that year on year. Whilst it is expected to be lower in 2024, we can still see a little bit higher than 5.5. So when we take a look now at the valuation of Digital Realty Trust, we get to the intrinsic value for today's episode that does sit at $169. So with our current price of $144, we use a 10% MOS to see it is a buy up to $152. 15% pretty much 45 cents shy. So with a 15% MOS level based on our estimates and judgments, we can see that Wall Street are expecting around 7% upside up to $154. Now, these are very high quality REITs, so if these are what you are looking for in your portfolio, it will really depend on what margin of safety you are looking for, and that can also be taken into consideration factors like the economy as well. As we mentioned at the beginning of the episode, we also want to introduce you to some ETFs in the real estate sector as well, for those that do prefer to hold them. So we have the first one, which is available, called VNQ. Now this has an expense ratio of 0.12%, slightly higher than those like VO, which tracks the S&P at 0.03%. And in terms of the allocation of this portfolio, we can see their largest holding is Prologis, which is what we just ran through today at 7.86%. They also have others like Realty Income that we see, which is a 2.77% holding, and Digital Realty Trust at 2.75%. But notably within their top 5, they also have American Tower Corporation, Equinix, Welltower, and Simon Property Group. Now, I know there are also viewers who don't have access to VNQ. There is also one for European and non-US investors, which we have here as iShares, a US property yield, ticker symbol IUSP. Now, something just to note with this, again, the expense ratio is unfortunately slightly higher, as we are about to find out, than the VNQ. So VNQ sits at 0.12%. This one does sit at 0.4%. So it is a pricier one. Do let us know your thoughts in the comments if there are any other non-US ETFs for real estate that is lower than 0.4. We will take a look on the channel. And in terms of their allocation, again, the highest and in fact a higher weighting is Prologis at 12.73%. They have Welltower, which is the second at 5.49%. They have Simon Property Group at Public Storage and Realty Income, which makes up their top 5. But similar to those that we did review today, they also hold DLR, Vici as well. As always, though, do let us know your thoughts in the comments below. Are you adding to any of these real estate investment trusts? Do you believe they are strong for a portfolio that does hold a certain percentage in that? And also let us know if you are into the thing of holding ETFs, whether that's VNQ or any other ETFs that we would like to run through on the channel at a later point. As always, have a great day. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop, and see you all on the next one.